How is everyone doing? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. So today we're going to be talking about FASB's update to what's called the CECL double count. So if everyone recalls, back in August, I did an episode about the supposed CECL double count, which was a big issue in bank M&A transactions. Basically, the kind of the double counting of loan losses, if you will, in kind of a short, summary in order to try to get to the heart of what was really going on there. So now, with that being said, FASB, which is the Financial Accounting Standards Board, they just came out a couple of weeks ago with an update that is hopefully going to correct this issue. So I wanted to take a look at this article from Bank Director, which basically is titled FASB CECL Update, What Bank Boards Need to Know. So bank boards should consider how to respond to the Financial Accounting Standard Board's new purchased seasoned loan standard. So let's jump into this for a second. So with the publication of Accounting Standards Update, which is known as ASU 2025-08, Financial Instruments Credit Losses, Topic 326, Purchased Loans, Subsection D, Category 5, Part 4. I'm just kidding. I know it seems like that, right? On November 12th of 2025, the Financial Accounting Standards Board, FASB, addressed an accounting issue that has been complicating bank mergers and acquisitions for several years. The update changes the accounting for loans acquired in an M&A transaction and other purchase loans. Overall, the changes better align the accounting for a transaction with the economic realities of the deal. While the ASU is not required to be adopted until 2027 for calendar year-end banks, directors and senior executives who have completed or expect to complete a transaction in 2025 or 2026 might want to evaluate early adoption of the new standard. Moreover, because it aligns the initial capital impact and ongoing financial reporting with the economics of the transaction, the new ASU could also influence how banks price and negotiate future deals, thus presenting boards with an opportunity to reevaluate their long-term growth strategies and acquisition approaches. So this has been a long-awaited fix. So under the current expected credit loss, which is known as CECL, the CECL model, issued in 2016, banks must carry an allowance for lifetime expected credit losses for all financial assets carried at amortized cost, regardless of whether they were originated or acquired. So for acquired or purchased loans that had not deteriorated in credit quality since origination, this meant acquirers had to record a fair value adjustment reflecting expected credit losses, otherwise known as the credit discount or the CECL double count. Banks also had to record a separate allowance through a provision expense for those same expected losses. Furthermore, the credit component of this fair value adjustment was accreted through interest income over the life of the acquired loans, distorting the yield. So the standard corrects these distortions by expanding the use of the gross up method, which previously was limited to purchased loans with more than significant credit deterioration since origination. Under the new ASU, banks apply the gross up method to loans, excluding credit cards acquired via a business combination or purchased more than 90 days after origination, if the acquiring bank had no involvement in the origination or was not exposed to the economic risks and rewards of the originated loan. This will allow banks to record these loans at their purchase price, grossed up for the allowance for credit losses at acquisition, without recognizing a loss provision expense. The prospective yield on these loans will now be comparable to newly originated loans, as the premium or discount on purchased seasoned loans will exclude any credit mark. So why does this matter at the end of the day? So banks on both sides of a transaction should understand how the accounting standard changes could make some transactions more feasible or financially attractive than they appeared under the old guidance. From a buyer's perspective, the new approach better aligns the balance sheet and income statement impacts with the economics of the deal. From a seller's perspective, it removes an artificial complication that buyers have often cited in price negotiations. In the end, however, the fundamental economics of a deal remain unchanged. The new accounting aligns the numbers with the economics, but it does not change the economics themselves. Boards still must focus on underlying value and the strategic rationale of every transaction. So what are some of the effective dates and early adoption? So the new ASU must be applied prospectively for fiscal years beginning after December 15th, 2026, including interim periods, but early adoption is permitted. That's huge. Early adoption is permitted. Banks could choose to adopt in 2025, either at the beginning of the fourth quarter or at the beginning of the fiscal year, and apply the new accounting to any M&A and qualified purchased loans completed during the quarter or the year. Boards should consider that decision carefully, weighing both the benefits and the operational demands. Banks that anticipated the change and prepared their systems to accommodate it could find early adoption to be relatively straightforward. But others might find it difficult to manage this late in an already busy reporting year. In some cases, the benefits of early adoption might not outweigh the cost and complexity, particularly if the transaction closed months ago and the results have been communicated to investors. So, questions bank boards should be asking, and questions to consider include: should we early adopt? What are the advantages and potential risks? Can our systems, data, and internal controls support early adoption? Regardless of early adoption, how could the new guidance affect transactions now being negotiated for 2026 or later? How will it influence pricing assumptions? What are the expected effects on future capital planning, financial reporting, and investor communications? Above all, are our strategic decisions still driven by sound economics rather than accounting outcomes? Ultimately, boards must continue to evaluate potential transactions based on their long-term strategic and economic merits, not the mechanics of the accounting treatment. True, but this really is. I think this really does help. I'm not going to say that this is like this massive game-changing event, but I think this really does help at the end of the day. The CECL double count, was an issue, and it did create a lot of issue in negotiations. And not that, if you're trying to put a bank M&A deal together today, obviously banks, the sellers are looking for X premium. Buyers obviously don't want to pay that premium. There's always been that gap between buyers and sellers, what sellers are willing to pay versus what buyers are willing to accept. You also have the issue of unrealized losses on, in the bank's bond portfolio. Some banks are obviously, that's a bigger issue than others. But if you do have those unrealized losses, that creates an accounting issue when you go to basically sell the bank, if it hasn't been addressed already. And then you get into all these issues with CECL. You could have uninsured deposits, like that could be another issue there. So there's always, obviously, in contracts with vendors, always a big one. What's the contract with your core system? How long does that run? What does that cost to get out of it? All these kind of things. So you can run into a lot of issues as you go through a typical M&A deal, a typical M&A transaction. But hopefully, if FASB can get this right, this will just be one less issue that you'll have to deal with. So, okay. I will have a link to the episode that I did on CECL, kind of laying out the whole double count issue. I'll put that link at the end of this episode if you want to go back to get a little bit more detail on the whole CECL double count and the accounting treatment of that, as it were. I didn't really get into all that in this episode, but like I said, if you want to go back to that last episode, not a long episode. I think that one was just like 10 or 15 minutes, so you could basically get what you need and get out pretty quick. But like I said, there'll be a link to that episode at the end here. So with that being said, I thank everybody for watching. I'm going to wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I thank you so much for watching and listening, and I hope you have a great day out there. I'll see you again real soon. Thanks a lot.